welcome in everyone. I hope you're having a good day today. Today we're going to be doing a quick little valuation tier list. I've got 30 or so, I believe it's like 32, 33 of the most popular companies in the market recently. I see these on Twitter. They're very big companies, small companies. There's a wide range here. But yeah, we're going to basically run through a quick valuation model. We're going to look at, we don't have time to deep dive any of them as we have 30 something to get into, but we'll look at the way they've been trending recently, and we'll do a quick valuation of them, and I'll put them in the tier list. Starting at the top will be obviously the cheapest ones, the ones that are just, that I believe at least are really, really attractively valued today. And then down here at the bottom, stay away, egregious valuations. All right, the first company we're going to be looking at today is Apple. You all know it. One of the widest moat companies in the market. As you can see, over time, it's an amazing compounder. One of the best investments, one of Buffett's best investments of all time. But as you can see, ever since 2021, 2022, it's really kind of flattened out with their growth in terms of revenue, even free cash flow. And it's even down from 2022. EPS is also, actually, they have a nice spike here, but still, it's flattening out a lot. They're seeing like 5, 6, 7% growth. So let's see a little. We'll do this off of earnings instead of cash flow. I think they deserve a 30 EPS multiple all day. Honestly, maybe even a 35, but we'll do a 32. And let's say we see 8% EPS growth over the next 5 years. I think this is really reasonable. You might see 10. You're getting 8% returns with 10. You're getting 6% returns annually with 8. If we somehow see a 15 and they still keep a 32 multiple, you're probably doing a little bit better than the market. So I don't think it's terribly valued, but it has a really wide moat, so it's not going anywhere. So it's going to keep a high multiple even if they grow slowly. But I do think it's I'll put it in overvalued for sure. So yeah, let's look at Microsoft. All right, this is another great compounder. As you can see, a straight line up and to the right forever. Revenue looks the same. Free cash flow looks the same. You do a stock-based comp adjusted free cash flow, same thing. EPS, same thing. Good balance sheet, more cash than debt. And they're actually growing more than Apple recently. As you can see, past 1 year, 15% revenue growth. You've got, that's actually not great for the free cash flow, but they're investing a lot into AI, into their build out with their cloud as well. But yeah, still net income is skyrocketing. EPS, I'm sure, is, yeah, absolutely 16% over the past year. So we're seeing significant growth in Microsoft. This is a powerhouse company. I think they deserve probably the same multiple as Apple. We'll give them a 30. I think there's some threats with AI for some parts of their business. So, but they're trying to be the AI company is what their CEO said. So let's assume we continue the same EPS growth somewhere around 6. Yeah, we'll do 15%. You're getting 12%. I think this is a base case for Microsoft. We could see 10. The worst I could think is maybe 8, which obviously is not a great investment. But over time, you're going to make positive returns. And I think we could see something as high as 20, which would be, this would be really good returns. So I think this is a fairly valued company. It's obviously a really high quality company. So I would not be afraid to buy this one at these prices. It's not going anywhere. Microsoft is here to stay. So next up we have ASML. This is another extremely high quality company. This is one that I really wish I owned. Oh, sorry, I gotta go to insights. I really wish I owned ASML. It's one of, if not the widest moat business that I've ever fully researched. It powers the AI race. So, but yeah, as you can see, past 10 years, we're looking at 17% annual growth in the revenue, 23 pretty much over the past 1 year. The revenue is skyrocketing. Free cash flow is a little bumpy. As you can see, 2024 was really rough. I'm not too sure what exactly that was about, but still, over time, it's going up and to the right. Net income, same thing, up and to the right. We're seeing really fast growth. We're looking at a 2% free cash flow yield, 38 forward PE. So the balance sheet looks pretty nice. Over double the cash to debt. EPS up 22% per year over the past 10 and 38% over the past 1 year. I think this one's going to continue to grow. I think this also deserves. This one might even deserve. I'm gonna put in a 32. I think it could trade up to even a 40 at some points, but we'll say 32 just to be safe. I think the EPS will continue to grow. Base case somewhere around 15%. Not great returns. It's ran up a lot. I think we could easily see 20%. Still not great returns, and I think there's a world where we see 25% if AI CapEx continues to build out through TSM, Intel, all of their big customers. Which this is pretty attractive returns, 13%, but it's not blowing you away, and you still need a 32 multiple. We've seen this trade lower in the past, so I think this is definitely one that's asking a hefty price today, but it is extremely wide moat. One of the safest companies in the AI infrastructure build out race that I can think of personally. But yeah, we're going to keep it overvalued, similar with Apple. Great companies. I think they're slightly overvalued today. And the next up, we have Airbnb. Airbnb. All right, this one's also growing pretty steady. The price has not been great. As you can see, past year pretty much flat. 5 years, you're down 30%. So, but yeah, we're trading at a 24 forward multiple with a 5.5 free cash flow yield. A lot of that's going away to stock-based comp here. So after stock-based comp, you're getting 3.7. But we're growing pretty steady. Past 2 years, 11%. Past year, 10%. Past 5 years, 27%. So we're flattening out. The bookings are still going up around 10% as well. So we had a big EPS spike in 2023, but it's going up and to the right over time. I mean, it's over the past 2 years because of this, but 48% over the past 1 year. This is definitely a steady grower. I think we're going to continue to see maybe 10% growth, as well as they're eating away some shares. They're buying back 3% over the past 2 years per year. Yeah, let's do DCF. Let's do Airbnb. I think we could see, on average, we'll see 10% EPS growth. And I think they deserve probably, this is not near as wide of a moat as some of the other companies that we've covered. So I think realistically they should be maybe a 24, 25 EPS multiple PE. I think that's what they're going to trade at. They could go down to like a 20. So, I mean, if we trade down to a 20 and we see 10% growth, you're at 0% returns. But I think we're going to stick around at 25. We'll get 10% growth. We're still only getting 5% annual returns from today over the next 5. So not great. If we see it ramp up to 15, we're still only at 10. So we really need to maintain this multiple, grow at 20. Maybe we get a 28 multiple out of this thing. But this is really accelerating over the past 2 years, 20% EPS growth rate. You're finally beating the market. So this is another one. I think it is slightly overvalued. I like the company. I'd like to see it, scale up just a bit more. It seems to get a lot of heat from like local governments. They hate Airbnb. I don't know why. So it gets a lot of scrutiny, but it is a really cool company. But yeah, I believe it's overvalued as well. And then next up, we have Visa. This is one of my favorite companies in the market. Visa, yeah, I mean, duopoly with Mastercard, one of the strongest business models in the market. They're growing really fast too. You're getting a 25 forward multiple. Trump's kind of coming at them recently. Not really at them, but at banks. To cap the interest rates on credit cards around 10%, and that's just going to kill both of these businesses, Visa and MasterCard, as well as the banks that are issuing the cards, if that was to stick. But I really, really do not think that's going to stick, at least long term. Maybe it goes into effect and they realize, wow, this is hurting the whole economy. But yeah, we're looking at 25 forward PE, 3.5 or 3.4% yield, 3.3, so not much stock-based comp at all. You're seeing, look at this revenue chart. The worldwide economy shut down and it barely dipped. But I mean, you could almost draw a straight line on this thing. It's insane how high quality this company is from 2006 to 2025, 20 years. It's just straight up to the right. It's not explosive growth, but it's double digits every year. We can expect the same thing in the future. Same thing for free cash flow. It's a little more bumpy. Over time, it's up and to the right, even if it amplifies it if you take into account stock-based comp per share, free cash flow, EPS, because they're buying back shares always, past 10 years, 15%. Slowed down over the past 1 year. I think that's a one-time thing. But yeah, you can see the shares outstanding. They're deleting them. Dividends, great dividend growth stock for you guys out there. We're seeing 11% over the past 10 years. Yeah, this is a great company. It's one of the widest moats, highest quality companies I can think of. We'll do this one on free cash flow. I think this deserves a 3 realistically. It trades around a 3 free cash flow yield a lot of times. But we'll say it sticks close to where it's at today, 3.3 free cash flow per share growth. I think they could do 15. I think for a base case, we'll stick around 12. So you're looking at 12, 13% returns over the next 5, which is solid. If something goes south, I think it could maybe go down to 8 or 9. And maybe they trade at a 3.5% free cash flow yield. So you're still getting 7, 8% returns in a I would consider a bear case. And then there's a chance that we ramp up. They have value-added services that are high margin. They're ramping those up. So say we traded at 3.2 and we grow at 16%, you're looking at 17 and a half annual. So, I mean, that's over doubling over 5 years. That's a great risk reward for one of the best businesses to me. I'm going to put this in undervalued. I don't think it's dirt cheap, but for the quality of the business, I definitely think it's undervalued. Next up, we have Spotify, another company I really like. Everyone that uses it loves it, of course. The monthly users up and to the right, slowing down a little bit. They're kind of they're slowing down. They're getting bigger. So free cash flow, they've hit profitability and it's just skyrocketing. It reminds me of Netflix post 2022. It just kind of up and to the right now. Same with net income. Balance sheet's great. 10 billion in cash, 0 debt. So you're paying 95 billion for this thing. You're looking at a 3.3 free cash flow yield, 35 forward PE. So it's a little expensive, but you're looking at really fast growth, as well as the margins are really kicking in. That's why the free cash flow is going up. They're hitting profitability. It's kind of like Uber right now. Let's pull this up. We'll do this on earnings. They're trading at a 35 right now. So I think the appropriate multiple, let's say 25. It's not a crazy wide moat company, but it is high quality. It's reached scale. And we could see, I think 20% EPS growth it's definitely achievable. As you can tell, it's not priced in for them to be this bad, but I think this could happen. You could see it slow down to 20%. We could easily see 30. I think this is a base case, maybe 35-ish. They'd probably trade closer to a 30 multiple if they were growing at 30%. So you'd see something in maybe a 28. So you're looking at 5, 6, 7% returns if we see 30% EPS growth over the next 5. But there is a chance they grow at like 45, probably not 50, 45%. At this point, they would trade over a 30 if they were growing this fast, 32 multiple. So you could make a lot of money on Spotify here. This would take great execution. So I think there is risk with the valuation on Spotify. It is a great company. I'm going to say it's fairly valued today. It's close to overvalued, but it honestly might need to be an overvalued just because it's not as high quality as ASML or Apple. But I'm going to stick it in fairly valued for now. We might go back on that. Next, we have Amazon. This is a company I really wish I owned. I might own in the future. Not asking for much for the business that it is, 31.4 multiple, but free cash flow has always been in the dirt for Amazon because they're investing so heavily. Revenue up and to the right. They have so many revenue segments. They have AWS. It's growing crazy. Advertising is going insane. They have subscriptions growing a lot as well. It's one of the best businesses in the world. Net income. Look at that. Wow. Past 2 years, 95%. So, I mean, explosive growth. I think the same thing for the EPS. Not as much, but yeah, it actually is 91% over the past 2 years, 50% over the past 1. I don't think that's going to happen forever. I think they'll be closer to the 5-year where they were actually, growing in 2021. Yeah, this is a fast grower. Let's do a DCF. Amazon, they're trading at 31 today. They deserve a 30 all day, at least. I think we could easily see 25% EPS growth. That gives you good returns. We could see it slow down to 15% EPS over the next 5. I don't think this is very likely, but it could happen. And even if it does, if they still trade at a 30, you're still getting market-beating returns, most likely. Market's usually around 10. And there's a chance, really. I don't see it happening, but there is a chance that they grow at 40, and they could get a 32 rating. They could even get a 35. I don't see that sticking for very long, but you could see 40% returns over the next 5 for Amazon. It is possible. So this is the first one I'm going to put. I don't think it's dirt cheap. There are risks. They reinvest so heavily. It's such a capital intensive business. So I'm going to keep it in undervalued. It is really close to dirt cheap, honestly. I've been looking at Amazon a lot recently. I really should have bought it when it was close to $200 per share last year. Let's go to the next one. We have Mastercard. This is probably the company I've been buying the most 2026 so far, and the back end of 2025. Very similar to Visa. Great company. The value-added services, look at this. 20% growth. And it's now, it's like a third of their revenue or more. A little more than a third. So I think if both of these segments continue to grow at the same rate, I think it'll only take like 4 or 5 years for value-added services to be the biggest part of their revenue. But yeah, this company is, look at this. Shares outstanding just permanently going down. Same with the dividend permanently going up. EPS permanently going up. There's hardly any hiccups. I mean, you have 2020, the economy shut down. They barely dropped. So one of the highest quality companies. Trump's kind of going at them again with the 10% cap. I think we're going to continue to see something close to what they've been doing, honestly. We could see 20% growth. So actually, I want to do this on cash flow. I like looking at them on cash flow. 33% over the past 1 year, 20% over the past 10. It is possible, especially with value-added services taking off. Let's do 20%. They've traded down at a 3 multiple times. Let's say they get a 3.2. You're getting 23% returns. I think there's very low risk with this company. It's capital light. It's everything you want in a business, really. It's like a toll booth on the economy. Let's say we slow down a little bit. 14% free cash flow per share growth. You get a 3.5 yield. You're beating the market still. You're doubling in 5 years. Let's say the 10% caps somehow stick. I don't know how Trump would do that, but 9% still. I think this is the worst case scenario for Mastercard. You get 9% annual returns over the next 5 years. I love this company. I really want to put it in dirt cheap. I think we would have to see another 10% taken off the share price today to put it in dirt cheap. So I'm going to stick it in undervalued. Next up, we have Nike. This company has been a mess for years. One of the best companies in the world, best brands, probably the best brand in the world, maybe. But they've been going through it. As you can see, revenue peaked in 2024. It's been going down. So they're in the middle of a turnaround. Same with EPS, spiked in 2022, 2024. But management is hopefully turning them around. I really want this company to succeed. I don't own the company, but I really like the brand. So they're trading at a 32.4 PE. They've always traded pretty high. I mean, this could continue to decelerate, or sorry, go down. But I'm gonna give them the benefit of the doubt. They traded at 30. It's asking for a lot. And let's say they grow at 8% per year. This is like kind of high for the way it's looking. It's been going down, so. But I mean, over time, they grow at 10, 12, 15%. So let's say this is a base case, 8. I think we could see this flow to 4. And they traded at 26 or something. You get negative returns. I think best case scenario, you see maybe 13%. They trade at something they're trading at now. So I really don't like the valuation of Nike. I love the company, but I'm going to have to put it in overvalued. I don't think you can, because there is a chance that they turn it around a lot quicker than I'm expecting, but I just don't see it. Especially with the price today, 32 forward is too much for that company right now with the way they're headed. So next up, what do we have? We have PayPal next. Let's pull this one up. PayPal, everyone knows it. 10.7% free cash flow yield, 8.5 roughly after stock-based comp, 9 forward PE. Insane. But inevitably, the business that they're in, it's slowly dying. Like, they're going to have to find some way to reaccelerate through Venmo, through Braintree. Something's going to have to change, or we're going to see them grow with or below inflation for the next 5 years. So that's roughly what they've done over the past 1 year, is less than 5%, 4.5%, past 2 years, 6%. Over the long period, 14%, but they were growing pretty fast here, as you can see. And the same thing with their active users. It's going down now, peaked in 2024. Or sorry, transactions per active account. Active accounts, it's flat pretty much, so. But EPS is still going up because of they're finding efficiencies and they're buying back shares. As you can see, the past 10 years, they've averaged 2% per year. They bought back almost 5% over the past 12 months. So the valuation is definitely cheap. It depends a lot on the execution and if they can turn this ship around. I do own this one. And I think just the buyback alone is going to save this company, shareholders, at least for the medium term, maybe the next 3 or 4 years. We'll do this on earnings. I think we could see with the buyback, they're buying back 5, 6, maybe even 7% of the shares if the price stays down. So if they grow with inflation 3%, they buy back another 4, 5, 6. I think realistically we should see 8% EPS growth if they stay on the same track, and the multiple maybe like a 12, 13, 14, something. We'll do a 12. You're getting decent returns, close to 10%. If they do find some kind of reacceleration through something picks up, something goes the right way for this company, and we see like 15% EPS growth, this thing re-rates to an 18. Really, really good returns. I mean, even if this is 12% EPS growth and we go to an 18 multiple, 23% returns. So this thing does have upside. If they can turn the ship around, they can really get it going. If they get back to where they were in the past and we re-rate to a 25, I mean, that's insane returns. So I am going to put PayPal. It's not the highest quality company. It's slowly dying. I don't want to put it in dirt cheap just because of that, but if they find any success in the future, this company is dirt cheap today. It's almost priced, and it's priced to die is what it is. So we're going to put PayPal as the first one in dirt cheap. The next stock we have is Tesla. Here we go. All right, here we go. Tesla. Everybody loves them. 205 forward PE, 0.47% free cash flow yield. Revenues are down over the past 2 years. I mean, I know it's Elon Musk. I like the business is really cool. I like some of the things they're doing. At the end of the day, Waymo's crushing them so far in robotaxis. They're a car company. That's what they mostly are. I know they're going into robots, but they're priced for perfection, and they have not shown any growth. Revenues down, free cash flow down, balance sheet's nice. You don't even notice it because they're worth 1.4 trillion. So sure, take 35 billion off of the price, but who cares? EPS is down. Let's do a DCF. Let's see what you need to make positive returns on this thing. Let's say they're the highest priced Mag 7 in the future. Maybe Nvidia is higher. Maybe Google. I doubt it. We'll give them a 40. I think this is at least 5 higher than probably what Nvidia will be trading at in 5 years, and Google and Microsoft. And let's say instead of negative returns, they have 20% EPS growth. You're losing 20% per year. The share price would be right around 150 5 years from now. So what do they need? 50% EPS growth with a 40 multiple? We'll give them a 45. You get 3% annual returns. I don't see it. I mean, I know it's Elon Musk. You can't just buy the company because the guy owns it. I know it's really cool. I love everything that he eventually creates. Like, he's made some great products, but I just don't see it. I've got to stay away. There's no way I could put my money in Tesla stock. Yeah, the next one we have Salesforce. This one is not Wall Street's favorite recently. It's been getting bullied pretty much. Same with all the other SaaS companies, but definitely CRM Salesforce. We're looking at 18 forward with a 6% free cash flow yield. Good bit of stock-based comp, so 4.5 after that. 18 forward multiple. It's slowing. The revenue is slowing. It's down almost now down to 8% when historically they've been at 20, 15%. So it is slowing. They have things going for them. The agent force is growing. So EPS has picked up. From 2021 levels, it's not that impressive. So the company's growing. I don't think it's going to die. They have a great product, a great CEO as well. But I think we could continue to see maybe 8, 10. We'll say 8 on the low end. Actually, we'll say 7 on the low end. They deserve a 20. It's a high quality company. You're losing money at this point. I think this is realistic, at least for a bear case. But we'll say 10%, and they traded at 22. I think this is a base case. You're looking at 3%. And maybe they accelerate with Agent Force. Maybe they accelerate with Agent Force and they rate to 25. Decent returns, 11% per year. I don't love Salesforce. I do think it's decently cheap. I don't think you're going to lose a lot of money, but I don't think you're going to make a lot of money in Salesforce either. I don't know if I want to put it in overvalued or fairly valued. It's probably right in between. I don't think it's as overvalued as Nike or ASML right now. But I would much rather buy Spotify at those prices. I'm going to put it in fairly valued. We might change our minds. But next company we have is AMD. I was an AMD shareholder. I sold it in October. I timed it almost perfectly somehow. But I bought it in April at like $100 per share. And I sold it for like $245. Either way, irrelevant. 38 forward multiple. The trailing 12 months looks crazy, but they're expecting a lot of growth. 38 forward, revenue's ramping. They're expecting it to accelerate even more. So 31% over the last 1 year. The thing is, I don't know how long this is going to last. And this is why I sold out of this company. I don't love the moat. I think Nvidia or a new player or anybody, Google, Amazon, they could eat their lunch. They're not the top dog in the market. Nvidia is definitely that. I mean, the EPS of the past 2 years, 310%. There's no way it's going to happen long term. A solid balance sheet, net income growing rapidly. So I think we're going to grow, I think over the next 5 years, you might see it accelerate over the next 1, 2, 3 years. But I think over the next 5, I'm going to give them like I think for a bear case, you could see 20% growth, and they trade at like a 22, 23, 24, we'll say 20, 22% EPS multiple. At that point, you're losing a lot of money. I think this is realistic. I wouldn't bet on this happening, but that could happen. I think 30% is more likely to happen, and we traded at 28, probably at 30. You're still losing money over the long term. Let's say we grow at 45. This could happen. This is almost what they're projecting. So they could even beat this, but I'm not going to project that. Let's say we'll give them a 38 multiple if they're growing this fast. I still don't think it's the widest moat business, so I don't think it's ever going to have a crazy high valuation. With this, I mean, this is like a pretty big bull case. I think this is on the higher end of realistic expectations, and you're beating the market here, but this is almost the most I would expect from AMD. I could be wrong. I really don't see them like taking over Nvidia or anything, which is what they would almost have to do for this to be any higher than 45% over the next 5 years. So AMD, I'm going to put it in overvalued. I think there was a time a year ago, 8, 9, 10 months ago, where it was, fairly valued or even undervalued at points. But today I'm going to put it in overvalued. It's traded up a lot. Next one we have is Adobe. This is my biggest position. Everyone hates it. No one likes Adobe. It's going to die. No one will ever use it again in 2 years, obviously, as you can tell from this chart. I'm not going to go into the details on Adobe, but trading at a 13 forward PE, 8% free cash flow yield, 6.5 roughly after stock-based comp. Still growing over 10% per year, slightly slowing. It's almost the same for the past 2 years. Past 5 years, it was 13%, past 10, 17. I don't expect this to happen, but it could. It realistically could. Free cash flow, same thing, up and to the right. I think it's even better on stock-based comp adjusted. Yeah, per share, 25% of the past 10. 37, this is unrealistic, dropped in 2024, but past 5 years, 15%. So the buyback's crazy. They bought back 6% of the shares of the past year. Insane. They're going to continue to do the same. They still have buyback program in effect, and the price is going down. So I know they're buying back shares right now. Let's do this we'll do earnings. I think, let's say they do get disrupted, or maybe Canva and Figma take over part of their business, and they grow at 4%. They grow with inflation. With all their pricing power and everything factored in, they grow at 4%, and they get a 20 multiple. You still get positive returns. You get 6.5. That's not, it's not good. But for this, as my bear case, 4%, I do not think this is going to happen. I think, honestly, the worst I could see is maybe 6%, and you're looking at 8.5. But they stay the course. They're growing roughly 14, 15 right now. Let's say they slow a little bit to 13. They trade at a 22 multiple. You're beating the market comfortably, 18%. Let's say they accelerate with their integrations of AI, and they change the pricing model to a productivity basis instead of per seat, and the market re-rates them. It's a really high margin SaaS company. So as soon as everyone's not scared of AI, I think companies, at least the ones that don't get disrupted, will re-rate to high 20s, maybe even a 30 multiple. You're looking at 24%. I don't really see how I can lose money in Adobe. I don't see it. Something would have to go really, really wrong. The valuation is not going to drop anymore. This is dirt cheap. This one is almost cheaper than PayPal, and I think it has less risk. So yeah, I love the valuation of Adobe. Next up, we have Costco. Let's see, what does it cost? Yeah, Costco, another really high quality company. I love this business. It's up and to the right. They're never gonna stop growing until they reach the whole world, which they're pretty far from now. So I think they'll grow for my whole lifetime, probably, if not close to it. Card holders, great chart here. It never goes down. I don't. Maybe one of these goes down, like right here. Nope, still goes up. Okay, they're getting card holders every quarter forever. Really efficient business. They're going to continue to grow at 8 to 15% EPS per year. But the valuation's high. Yeah, it's almost an indestructible company. Let's say bear case, we see, I'll give them 9%. Appropriate multiple for the quality of the company. It's not going anywhere. It's going to trade at a 30. You're going to lose money here. Not much. The valuation's pretty high. So let's say base case, they grow 12%. You get a 33 multiple. You make a little bit of money. If they somehow re-accelerate, I don't see that happening, but say they do, and let's say they traded a 36. You make decent gains, 7% per year. Not great. Really lovely company. I'd love to buy it one day, but I don't think it's in stay away just because of the quality of the company. And I don't think you can lose that much on this company, but it is overvalued for sure. Next up is Google. Here we go. One of my biggest holdings right there with Adobe. Everyone's selling out of it recently because it's overvalued now. It's trading at a 30 forward. One of the best businesses in the world. Free cash flow is low, but they're reinvesting so much right now. So I'm going to do this off of earnings. Revenue's growing 13%. This could reaccelerate, especially with Waymo taking off. Once they actually start making money, I could definitely see that happening. Net income's growing faster than revenue, 31% over the past year, 22.5% over the past 10. EPS is the same. Yep. 35%, 34.5% over the past 1 year. Past 10 years, 24%. Free cash flow looks the same. Past 10 years, 20%. Stock-based comp adjusted per share. Let's do a DCF. This company's gonna continue to win. I mean, everyone thought AI was gonna kill it. ChatGPT was gonna kill it. I don't think 30%. That's what they're growing at right now. But let's be realistic. Let's say they grow at 20. Let's say they trade down to a 27. They deserve it. Like they won't trade below a 25 unless they're getting disrupted again. I don't think so. I'll say 25 just to be fair. 20% EPS growth rate, 25 EPS multiple. You're beating the market. 13.5%. Let's say they stay the course. They're growing a little faster than this. They traded a 28% EPS multiple, 28% EPS growth, 30 multiple, 25.5% killer returns. And let's say they accelerate, with everything they have going on. I'm not going to dig into the whole company right now. I don't think they're going to trade much more than a 30 just because of the size of the company. I'm just going to give them a 32. Close to what they're at today. 32% returns. I mean, that's like a quadruple, or that's more than quadrupling your money in 5 years. Google is not, it's not dirt cheap. It was dirt cheap, but it is undervalued. I think Google is still a buy today. Next up, we have Nvidia. This one is a really popular company, as you would assume. I mean, this chart just looks silly. This company is like an anomaly. I don't know if I'll ever see a company do this ever again, especially at its size, because it wasn't a small company in 2022. 30 billion in revenue. That's a really big company, but to see it grow 66% per year for 5 years, 104% over the past 2 years. At its size, it's unreal. I mean, it's a higher moat company than AMD because of the software, but I still don't love this business. I think they could get, pressures for competition pricing could hurt this company, but they're going to continue to grow at least for the next 3 to 5 years, I think. Maybe the AI race can't figure out how to make money on it. I don't think that's going to happen. These big companies are going to keep spending. I just don't know. This is such a hard company to project because I don't know what's going to happen, but it's only at a 24.5 forward. I think for its growth rate, it deserves a 30. Or sorry, that's the growth rate. It deserves a 30 multiple. I think we could easily see 30% growth. And you're looking at 19% returns. I think for a bear case, maybe AMD eats their lunch, or Google or somebody, eats their lunch, or maybe AI spin slows. And we see, this is like a nightmare scenario. I don't see it happening. It's possible, but I don't see it happening. Maybe like a 5% chance this happens or less. 20% EPS growth, 25 multiple. You're looking at 6% returns. Not bad. And then let's say they continue this pace somehow. We'll give them like 33% EPS growth, 32 multiple. I'll give them 35. 25% returns. So you can definitely make money in Nvidia. I actually think it's undervalued. It's not my type of investment. I think investors are probably going to do really well from today. It's not expensive. It might look expensive in the trailing 12 months. What was the trailing 12 PE? 46.5. It looked a little expensive, but for their growth rate, it's not expensive at all. Next up, MSCI. I love this company. Definitely could see this being in my portfolio here soon. The index business is amazing. Some of the highest margin, lowest reinvestment needs in the industry. So 34 multiple, 3.3 free cash flow yield, 3.0 pretty much after stock-based comp. One of the steadiest companies. They basically make more money as the assets under management in their indexes raise, which meaning as the stock market goes up over time, they make more revenue and that increases their margins. So this business is phenomenal. There is a little bit of competition. S&P Global is a big player. They have the S&P 500. MSCI is more of like the world indexes, the VTI, a couple other ETFs that I'm sure you've heard of. They do like the total world. That's what they focus on. And then there's the Russell, the NASDAQ. There's players. So it does have competition. I don't see it being disrupted. It's such high switching costs. But yeah, I think we're going to see the same around 10% growth in the revenue. We're going to continue to see that. The free cash flow per share, 22% over the past 10 years. That's a little steep, but they do buy back a lot of shares. I mean, shares outstanding down 3.5% per year over the past 10 years, 2% over the past year. So it's slowing a bit. EPS up and to the right, 24%. Past 1 year's low because of whatever this is. I think they had a tax benefit or something that spiked in one of these quarters. But past 2 years, 15%. So I think we're going to see similar growth for MSCI. We'll do it on cash flow. This thing is traded down to 3. Let's say we slow down just a hair. We're at 12% free cash flow growth. We traded at 3.5. So the valuation gets cheaper than today. The growth slows. We're looking at 10.5, 11% returns. Not bad. That's right in line with the market. Over the next 5, let's say we stick to about where we've been, 14%. Traded at 3.3. You're looking at 14% returns. Not bad. And I think this is very real. I think the 14% is probably what's going to happen, but we could see 16, 17. We'll do 16%, and we traded at 3.1 free cash flow yield. You're looking at 17.5, 17.3 annual returns, which is really good. You're over doubling in 5 years. So I think this is a safe bet. This is one of the most stable companies in the market. It's close to fairly valued, honestly, but just because I don't see incredible upside with this business, but I am going to put it in undervalued just because I think the downside is so low with this company. So yeah, and then next up we have Intuit. This one has been getting beat recently. I really love this company. Hello? There we go. Okay, Intuit, SaaS, getting destroyed. As you can see, past this month alone, 14%, 1 year down 9%, but still over the past 5. Honestly, not good, but it was if you looked at this in, what is that, August? It's going through a big sell-off. Past 6 months, down 31%. Yeah, it's still a really high-quality company. Intuit, they have TurboTax, they have QuickBooks, a couple other things. Some of the best software in the world is in this company. So the revenue, it's accelerating. 2 years ago, 14%. Over the past 2 years, 14, 15%. Past 1 year, 17. Past 10 years, we're looking at close to 17%. I think this is going to continue to grow. I don't see AI replacing their software at all. Look at the EPS. This company is phenomenal. 10 years, 25% on average per year. Past 1 year, 42. I don't know if we're going to see the same amount of growth, but it is going to continue to grow close to this. Stock-based comp adjusted per share, 17.5% per year for the past decade. That's insane. They're a big dividend grower. For you guys that are looking for dividend growth, amazing. Past 15 years, 15% per year. So I think this one's going to continue to grow relatively in line with the revenue. Slightly more, they'll buy back some shares. But let's say they slow. Let's say something happens, they slow. We see EPS drop to 12. The multiple's down to a 20 because they're, everyone hates software. You do lose money over the next 5. This is very unlikely. It could happen. This is probably a 5% scenario, but it could happen. Let's say they stay closer to where they are, 16, and we trade at a 20, probably 28. We'll do a 25 multiple. Decent return, 7%. You're probably losing to the market at this point. But let's say they trade. This is about what they've been growing at. 20% EPS, earnings per share over the past 5-10 years. I think that's probably where they're going to continue to stay at. And they usually get a high multiple. I think they could definitely get more than a 30, but we'll give them a 30. You're looking at 15%. You're probably beating the market with Intuit. It's not super cheap. It's always priced high. It's a really high quality company though. I think it's probably fairly valued today. It's a great starting price if you wanted to start a position in one of the best software companies in the world. Maybe the best software company in the whole world. And next up we have Meta. This is another one I've been buying this year. A phenomenal company. 29 trailing. This is fake. Here, let me go to quarterly. They had a really big tax hit due to the big beautiful bill. This should be for this quarter. I think it was supposed to be, or sorry, where's EPS? It's very similar. but I think it was supposed to be close to $8 per share if it wasn't for the tax hit. So their earnings per share trailing is really like 24, 23, 24, 25, somewhere around there. But their forward is 22 and a half. It was like a 20 a couple weeks ago when it was below $600 per share. They're reinvesting heavily. That's why the free cash flow yield is a little lower. That will slow one day. I don't know if it's in 1 year, 3 year, 5 years, but the revenue, 20% in almost every window you look at here. 5 years ago they were doing really well, so you're seeing 19%, but 28% over the past 10 years. That's not going to happen. I don't think it's possible. I don't think it's going to happen. But yeah, I mean, this company's unstoppable. Half the world uses it every day. But yeah, we're going to continue to see EPS growth. This, like I said, this is due to the one-time tax hit. So the 1 year's a fake number pretty much. But past 2 years, you're looking at 40%. That's not going to happen. I think we're going to be closer to this 20. I think base case, you see it slow to 15. They're going to trade it at 25. It's one of the best companies in the world. You're beating the market. This one is really, really cheap. We'll do 18. They traded at 28. 18. This is like a base case. You see 22% CAGR per year. Amazing returns, and I think you could see acceleration up to 22% EPS, and they could trade at a 32 easily. This company has traded at a 32 multiple times in the past. It's traded really low in 2022. But I think this is where the market's going to value it in the future. We're looking at 30-ish% returns per year, quadrupling your money in 5 years. I think this is one of the best buys in the market. I think this is dirt cheap. Under $700. It's close to undervalued. It's not as cheap as Adobe or PayPal, but I do think it's dirt cheap. I think it's clearly cheaper than all of these companies. The closest one being Mastercard probably, but I would definitely say Meta's definitely cheaper. Uber, this is a very controversial one. People love or hate this company. Yeah, so they have a 23 forward, 23 and a half, 5% free cash flow yield, 4 after stock-based comp. Growing really fast. This company is taking off. They've actually reaccelerated from 2 years ago to the past 12 months for revenue. 32% over the past 5. I don't think they're not going to grow at 32%, but they'll probably grow in the high teens. The big problem is one of these autonomous vehicle players going to take the whole market? I don't think it's going to happen. If anyone were to do it, I think it would be Google with Waymo, because they have the money and the cash flow from their search business and YouTube to just literally lose money for years to take over the whole market. But I think at the end of the day, we'll have Tesla will be in the race. Zoox will probably be in the race. There will probably be 4 or 5 players, is my bet. But there's probably a 5, maybe a 15% chance that Uber does get disrupted by autonomous vehicles. I don't think it's going to happen. This company has hit profitability, and they have flexed their pricing power, growing really fast. I don't think that's going to happen consistently over the next 5 years, but I do think we see fast growth. Look at the trips, 20% per year over the past year. You would think the company's like mature. It's not. It still has room to grow. So there is a little bit of risk with this one, and that is them getting disrupted. I don't think that's going to happen. I need to change. Okay, I had to look that up. I believe it's right around $2 in earning per share over the past 12 months if you take away those one-offs. Probably, I think it was closer to 3 actually. So I'm gonna adjust the earnings per share. Uber, we'll do 3. I wish it would show me the multiple that would put them at, but anyways, I think we're gonna continue to see 25-30%. We'll see. The bear case, they do get disrupted. I don't think it's going to be within the next 5 years, but maybe we start to see it slow. I don't think it's going to happen. EPS growth 15%. This is slowing. I'll go lower. I'll go 12. EPS multiple. Let's say we see them starting to get disrupted. It's priced in that way. They could fall to like an 18 multiple. You're still getting positive returns, 3%. Maybe the valuation drops to 15, kind of like Adobe. I don't see it happening. So I don't really see you losing money on Uber at this valuation. Let's say you get 20% EPS growth and they hold a 25 multiple. You're beating the market. Killer returns. Let's say they continue accelerated growth, maybe 25. We could see 30. I'm going to say 25, and they trade at a 28. Let's say the water's clear. AVs aren't going to take over Uber. They're going to continue to grow. They traded at 28 multiple. You could see 25% returns over the next 5 years, over a triple in your returns in 5 years. So this one's definitely cheap. It does have risk. Is it dirt cheap or is it undervalued? I think it's cheaper than all of these right here. So I'm going to put it in dirt cheap. I think it's a little more expensive than Meta, Adobe, PayPal at this point. Maybe not Meta. I think it's definitely in the dirt cheap category. Next up, Zeta. I don't know hardly anything about this company, to be honest. But if you're on Twitter, X, whatever, I think if you have an X account, you have at least a 10% position in this company. Other than me, from what I've seen, I don't know enough about the company. I'm just going to look at some charts. I really don't even know what they do. I just haven't had the time to look into the company. So it's a smaller company. I try to stick to bigger companies, more established, longer track records. So not one that I've really looked into at all. But we can see 35% revenue growth over the past 5 years, 2 years, and 1 year. We're looking at a 21.4 multiple. I think that's because they're unprofitable. Yeah, they are. Have they hit it at all? 1 quarter. Okay. But as you could tell, just from the trend, they're most likely going to hit profitability. Like I said, I don't know the business. I hardly know anything that they do. I know there's some kind of software. But free cash flow. How is this? Oh, it's because of dilution, I'm assuming? Yeah, okay. So, yes, that's exactly why. Look at the dilution. Wow. That's a problem. That is a problem. They have almost doubled the shares since 2021. So, I will have to take that. Let's look at this on a... Yeah, okay. That clears it up. Stock-based comp is killer. Let's look at both of these. Okay, so they ramped it up, but these are converging. This is what we want to see. I don't know how to value companies like this. I mean, it's so many things have to go right. They have a lot of risk with this much stock-based comp. They have more stock-based comp than free cash flow. That's why the EPS is still negative. But just off of this growth rate, I'm going to say they're going to grow similar to in line with revenue. I'll put it a little below. Yeah, let's give this a try. I don't really know how to value this company, I'll be honest, but everyone talks about it, so I figured I'd throw it in. All right, this is going to be really hard to model because everything's negative. I just don't know how to. I don't look at companies that are unprofitable for the most part. So, but the free cash flow it's basically all eaten up by stock-based comp, so it's pretty much zero. But it is showing on here 3.5% yield. That's fake after stock-based comp is negative. So we'll look at this off cash flows. With the stock-based comp, they're growing revenues above 30%. Stock-based comp, not factored in. They're converging. The stock-based comp is going down. Free cash flow is going up. Like I said, I don't know much about this company. Don't take me too serious here on Zeta. But let's say they get a free cash flow yield of 3. They grow at 10%. Due to the stock-based comp, 10% free cash flow per share growth rate. You're seeing 13% total returns. This could be 0, like say stock-based comp and free cash flow equal out. And we'll do 0.5 just so it runs something. You don't see much returns, but there is a bull case here. I mean, let's say the chart continue, free cash flow goes up like this, stock-based comp continues to go down like this. We could see 30% in line with revenue. And for them, let's say 4% just for the size of the company. But it does have high growth rate. So I could see this, taking off like a rocket ship, 26%. You could see $60+ per share in 5 years. That is very possible. So like I said, I don't know much about this company. I just wanted to throw it in because every person I know on Twitter owns the company. Like it's like half of their portfolio. I haven't looked into it. But I'm going to put it in fair valued. It seems like it has really high risk, really high reward. But all the charts are going the right direction. So next up we have Broadcom. This is what everyone wants the new 7th company in the Mag 7 to be instead of Tesla. I would agree. Much higher quality company in terms of the business itself, as well as the valuation compared to Tesla. This company is taking off 10% revenue growth, over the past 10 years, 25% revenue growth. It's over 20% in every time frame that you look at. But as you can tell, for the past 2 years, 33%. It's really taken off with the AI build out. Free cash flow, explosive. This is fake because it dipped, but 20% over the past 10 years. EPS past 10 years, 25%. This is fake kind of in the 1 year. That's 290% obviously fake, but it is spiking. So it's probably realistically 30%-ish. But yeah, so this is a fast grower. It's not asking for too much. Let's run it. We'll do this off EPS. Let's say they grow at 30 per. Let's say they grow at 25%. There is risk that AI build could slow. They're probably gonna still get a 25% multiple. So you're looking at pretty much flat over the next 5 years. Let's say they continue their growth, probably around 32-ish%. They get a 30 multiple. Solid returns here, right in line with the market. And if they accelerate to 40% and the market wants to give them a 35 multiple for this high growth, you're crushing the market at that point. 22%. It's a high quality company. It does have risk, kind of in a cyclical business. So you could triple up though if you hit the bull case. So it's not terrible. I don't think it's overvalued. It probably was at its all-time highs recently. I'll put it in fairly valued. It's close. I'll put it at fairly valued. I don't think it's the strongest company in the world, but it is a really high quality one. So next up we have Duolingo, everyone's favorite stock. Everyone's least favorite stock in the world. This company will probably be out of business in the next month or two if you ask Twitter. But here we go. It's traded down. The trailing 12 months is fake. They had a one-time tax benefit. But next 12 months, looking at 33.5 multiple. The revenue, this chart is insane. It's slowing, sure, but it's still 40% past 2 years, past 1 year. Subscription revenue, which is most of their revenue, 46%, 48% past 2 years. Daily users, up 35% over the past year. Paid subscribers, up and to the right. Monthly users, up and to the right. This is slower, but it's fine. They're looking for daily active users. They're probably gonna see close to 20%, maybe even slow down to 10-15% in the monthly users. But I believe the daily users will continue to grow. It's an addictive product. I don't know if you've ever used it. I haven't used it that much, but I have used it in the past. Free cash flow, up and to the right, even if you account for stock-based comp, which hurts it. Yeah, up and to the right. Really fast. So same with EPS. Like I said, this is fake. This is like a one-time thing, but still up and to the right. I can see this. This is probably what Zeta could look like if they continue to execute. This company is clearly undervalued. They will have to get disrupted or pretty much wiped out for people to not make money here. They're going to continue to grow. Their current yield's 5.5. Well, we'll do this on earning. No, we'll do cash flow. Let's say they grow at 20%. They slow down all the way down to 20%. They trade at they're at a 5 yield right now. They're not going to be any lower than that at 20% growth. Let's do 5. I guess I'll give them a 6. And let's say they really, really, really slow down, like half the rate of their current growth. You have market returns. Let's say they stay on track. This is honestly slower than where they are, and they traded a 4.5 yield, crushing the market. Let's say they accelerate a little bit and you trade at a reasonable rate for 35% free cash flow per share growth. You are like, this is like a 6x in 5 years. Yeah, this is like a 6x. I mean, this is one of the highest upside shots in this tier list, in my opinion. It does have risk. People think that people are going to, instead of using the fun app that is addictive, that people come back to every day for their streak, that actually teaches people, sure, you're not going to learn Spanish or French or English or whatever just from Duolingo, but it is a tool, it's helpful, and they're expanding into chess, math. They're the market leader for sure in education. They have like a 70% market share in their specific segment. So there is risk here, but I think after the market stops freaking out over AI, they're treating them like a SaaS company, but on steroids. I think this is dirt cheap. It does have risk. There is a chance where you lose money. This company goes south, but I don't see it happening, not within the next couple years at least. and I think there's a chance they take off, really. But next company, we have GE, the Chris Home company. This one's really hard to look at just because it's like a spinoff. They spun off all those different segments of their company. So this looks terrible, but I mean, you have to look in the future, of course. They're trading at a 40 forward, and they're going to continue to grow right around this 20%-ish rate. They have pricing power. They're basically a monopoly, duopoly. The EPS is going to continue to grow 30-ish%. I think they buy back some shares. Yeah, they do. They buy back 1-2% per year. So that helps their returns. This is one of the highest quality companies that I've ever researched. I'm not going to dig in too deep into it now. Over the next 5, I think we could see 20% EPS growth easily. They traded at a 30 multiple. This is like a base case. You get 15%. Maybe it slows to 12% and you trade at a 25. I think this is really, really unlikely, but it is possible. This would have the market selling them off as well as slowed growth. I don't see, they're going to have to see some competition or something for this to happen. Or maybe less people fly for some reason, less demand for airplanes. I don't really know how this would happen, but it is possible. You have to factor that in. I think this is probably more realistic as a bear case, 6% returns, 20% growth. Like I said, 30 EPS, 15%. I think this is a base case. You're looking at 15% returns. And let's say they accelerate 25% and they trade it at 32 multiple. 21, 22%. This could go up to 35, 24%. So this is fairly priced all day. Honestly, probably undervalued, especially for the quality of the company. I'm definitely going to put it in undervalued. I love this company. I really need to do more research on it because it's a great company. I've only really heard Chris Hone talk about it. I've done a little bit of research into it, but the spinoff really confused me. So I kind of just put more time into the companies that I already owned. But next we have Toast. I really like this company. I don't see many people talk about it, but I think they have they're starting to carve out their own little market in the POS systems in restaurants. And they've kind of have like, basically if you want to open a restaurant and you want someone to control your whole system easily, and it's specific to restaurants and it's specific to restaurant types for your whole system. So I'm not going to dive into everything now. This video is really long already, but they're at a 26.4 PE multiple. The revenue up and to the right, it's like a perfect straight line. You know, I think they're going to continue to see 25% growth. It might slow to 20. Free cash flow is up and to the right. The stock-based comp's eating into it, but they're getting that under control. The balance sheet's great, 1.8 billion in cash. So you're basically paying 17 billion for this thing that has 6 billion in revenue over the past 12 months. EPS is going to continue to, they finally hit profitability. It's going to continue to go up. The margins are expanding. As you can see, operating margin. I think this is going to be close to 10% in the relatively near future. So I think this is honestly a fair price to pay for this company. I think we could see easily 20% growth. And we traded at 30. You're flat. This is like my bear case. And then we could continue. We're growing. We're closer to a 30 now. It's more like a 40. I'll do 35 for the base case, and you trade it at, we'll keep it at a 30. You're beating the market. If you're growing 35, you're going to be at a higher multiple. You're probably going to be somewhere around this 15% return. And I think they could reaccelerate easily, especially with margins expanding, and we could see a multiple close to 40 with the 45% EPS growth. You're looking at 28% returns. So I really like this company. There is a downside, maybe, 4 or another POS system, Square or something, starts to take away market share, but they are the market leader in restaurants and their market share is growing. I think that's going to continue to happen. They're going to continue to see recurring revenue. It's going to grow over time. I think this is a fairly valued company all day. It does have risk. It's a smaller company. It doesn't have a long track record, but I do really like the price on this one today. Next up, we have, Intuitive Surgical. This is one of my favorite companies. I really wish I owned it. I wish I could get a cheaper price on it, but here we are. They basically sell their Da Vinci system, which is like a robotic surgery, like a platform almost. It helps surgeons do surgery like remotely with the robot. It's very helpful. It helps humans live through surgery. It helps their effectiveness, and it is like so much of it is recurring revenue. And the moat on this company is so wide, it's unreal. One of the widest moat companies that I've ever fully researched. So I would love to own it, but I can't pay 52 forward for it. 1.2 free cash flow yield. But I mean, the charts speak for itself. It's accelerating 1 year, 20%. Because so how this happens is they install DaVinci. It costs like $2 million, and they have it's like a razor and blade business model. So they sell you the razor, which is the DaVinci, the the platform to do your surgery on, and all the little things that you use in it, the little tools, scalpels, different things, they're specific to the DaVinci, and they're high margin. So after it could be after one surgery, depending on the piece, or it could be after 5, 10 surgeries. Either way, that's recurring revenue. You have to keep paying them like 50% margin on these different dispensable parts of the operating system for the DaVinci. And then they also have service contracts. So the more DaVincis that they have installed, the more revenue is going to continue to grow because of the recurring revenue. So they're getting the revenue from selling the DaVinci model, as well as the recurring revenue is going up at the same time. So it's like exponential growth in the revenue. I think this is on this, unless they face strong competition, which is really hard to compete with them. You need FDA approval. It's a $2 million machine. People aren't going to switch from their $2 million machine to someone else's $1 million machine because it's cheaper when they already have the system installed. So as their install base inclines, their revenue over time is going to continue to grow exponentially. Same with their EPS, 23% over the past 1 year, 16% over the long term. Balance sheet's great, $5 billion. So you get a little bit of a discount in that sense, but they do invest heavily. But this one's going to continue to grow. Like I said, the valuation is just so high. We'll do it on earnings. The revenue is growing 21%. I think it's going to continue to grow. Let's do a bear case. Let's say it slows. They face some competition. It grows at 16%, and you see a multiple of right now it's at a 52 forward. It's never traded low. It's such a wide moat. Let's say it trades to a 30. They face some competition. They're getting disrupted. I don't see it happening. But let's say it does. You're pretty much flat. You might lose a little bit of money over the next 5. And let's say base case, they grow right in line with their revenue currently, 21. I'll do 20%. They trade closer to a 35. You get decent returns. You're losing to the market for sure here at 5.5% per year, but you're not losing money. And let's say, I think this is what's going to happen, honestly, is 25% EPS growth. It's probably going to be even closer to 30. I'll give them that. I'll give them 28 for this exercise. 28, and they keep a 40 multiple. I mean, a 40 multiple is a lot to ask for, but they trade at like a 50, 60. So if they keep their multiple, you see great returns, but that's a risk. If they lose their multiple, 40 is still high. You're at 15% for the bull case. So I love the company. I would love to buy it under a 50 PE, but it's expensive. It's overvalued. I think if we could take 10, 20% off the current share price, you could buy it. You could buy it today and just over time, it's going to catch up to the valuation. But for 5 years out, you could be relatively flat even with great execution. So next we have Netflix. This is my most recent add to my portfolio. Everyone knows Netflix. Amazing company. One thing that's very slept on is they almost have like a network effect to where the more subscribers that they have, that allows them to spend more on content. So for every new customer, obviously that brings down their cost of production for new content. But if they add more customers, they're going to be able to add more content to Netflix. Therefore, more people signing up, it's going to improve Netflix for the consumers. So that, and there's also like there's a network effect in a sense where everyone watches Stranger Things at the same time, or Squid Game, or whatever. Everyone's talking about it. You if you're in a friend circle and they're all watching the show, you're gonna get Netflix to watch the show too. That and the games, the party games, those are really high margin. Those are really cheap for them, and people continue to sign up for those little games like Pictionary and stuff like that. Whatever they have on Netflix. But yeah, now it's traded off there due to the Warner Brothers Discovery deal, which could hurt the balance sheet. But I really think if that goes through, the worst thing that could happen is it gets broken up by like the government doesn't let it go through. I think they have like a 2.7 billion breakup fee, so that would really hurt the balance sheet. But it would be fine. It would slow down Warner Brothers Discovery for a year or two, as well as Paramount is pulling out their hair trying to buy this company. So everyone involved, it would slow down everyone, but it wouldn't be great. I think if they do acquire Warner Brothers Discovery, the balance sheet's going to be in rough shape. It's pretty expensive, but over the long term, over 5, 10, 15 years, it's going to improve the quality of this content so much. They're going to be able to double, triple, quadruple the cost of a Netflix subscription. They're going to be able to charge more for ads. This company's going to grow rapidly. So, I mean, we're seeing revenue growth 15%. This could accelerate, especially with Warner Brothers. It's going to accelerate if that goes through. EPS shooting up into the right. Insane. 10 years, 56% per year. That's unreal. Over the past 1 year, 27%. So I think we're going to continue to see this happen. Netflix. Let's say something goes south. Warner Brothers breaks up. It slows down Netflix. You see 20% EPS growth. I mean, I'll put it lower. Let's say 12%. We see a recession. Some people cancel their Netflix. YouTube continues to, YouTube Prime, HBO, all these other things, they continue to do well. They eat away market share. Like, this is the worst case ever for Netflix. You get 5% gains. I think this is closer to a base case, 20%, which is slower than what they're growing at. It's a defensive company. It's going to trade around it. I'll give them a 28. You get 15%. You beat the market, base case. Over the long term, they get Warner Brothers. They continue to scale and flex their pricing power. They trade closer to where they usually trade, 35 PE. You're looking at 30% returns. This company's a buy and a half. It's almost dirt cheap. I'm going to put it in dirt cheap. I think it is dirt cheap today. I bought it at $80.75 in the pre-market one day, so that was definitely dirt cheap. It's closer to $84 today, but still really cheap company. Next up, we have Novo Nordisk. This video is going long. We need to hurry this up. This company is Ozempic. You know this company. You may not know the company. You know the product. This company looks cheap on the surface, but the thing is, the market is expecting Eli Lilly and other competitors to eat away at some of their market share. But at the same time, the market share for weight loss drugs is supposed to be one of the fastest growing sectors over the next 5 or so years. So we're looking at revenue growth of 20%-ish. It's a little bit slow recently. Free cash flow up and to the right. It's actually not near as much as the revenue. For whatever reason, I don't know too much about this company. It's not my type of investment. It's not super high moat. But yeah, I mean, still, the company's growing really fast. It has risk with disruption, with Eli Lilly taking market share, other competitors. So for a bear case, EPS growth, it's been around 8%. So I think we could see a bear case around 5. Say Eli Lilly really takes off, and they trade at a 15 multiple. This is possible. You get 3% gains over the next 5. So, and we'll do a base case. They're growing around 12. They traded at 20. This company's not going to trade at a high multiple just because of the moat. 16% per year. Still really good returns. Let's say we get 15 and we trade it at 25. So, I mean, this is great returns. So, it is cheap. It does have risk, though. With the risk included, I'm going to put it at fair valued. It was probably undervalued when it was 20% lower a month ago. I'm going to put it at fair valued for today. It's close to undervalued. This company, you never know what's going to happen in the future. They've faced problems with illegal GLP-1s taking away market share. And, oh, there's a cat. Sorry about that. All right. Next up, we have Robinhood. Here we go. Robinhood. Everyone loves Robinhood. 42 forward multiple, 1.1 free cash flow yield, closer to 0.8 after dilution. Growing really fast. This company really hit their stride this year. They took a lot of market share. They're doing the prediction markets, their crypto, options trading. They're really diving into the degeneracy of Gen Z investors. but it's all high margin, so it's going to continue to grow. I don't see many apps taking their market share within the next year or two, but it's not super wide moat. Anyone can repeat what they're doing, but it has a nice balance sheet, 14 billion. So you're paying 80 billion for this thing, pretty much. That's hard to say because it holds a lot of cash from investors. So, but yeah, we're going to continue to see growth. I think not this much, but we could see. Let's say, let's go to the DCF here. Let's say we see, I think 20% on the low end is realistic with a 30 multiple. You're looking at 10% returns. We'll drop this down to 15%. Maybe someone comes in, really takes their market share, the market goes down. A lot of investors aren't doing prediction markets and, you know, options and all this other stuff. So for a base case, I think we could see 22% growth. Should have dropped the multiple for the bear case. I think 30 is fair to say in the base case. We're looking at market returns a little above. Sorry about that. And then for the bull case, I think we could see maybe 30% growth, and we traded at 35. So there is a route to great returns in Robinhood. I'm going to put it in fairly valued. It's close to overvalued, maybe. I think, honestly, it belongs in fairly valued. It's right there with Novo Nordisk. It's not super wide moat, so it does have downside risk. But next up, we have UNH. This is talk of the town today. They're down like 20%. This company, sorry, go to insights. This company is too big to destroy completely, but it just faces so many like regulatory holdbacks, and the government's always on them. It's really hard to see this company like being explosive, but they do have a really low valuation now. So they're expected to lose revenue to, I think, decline now over the next 12 months. So they really messed up with their pricing. It's going to hurt their numbers over the next coming years. But I think over a 5-year window, we could look out and see this thing grow at 8%. I will do a bear case of 6% with a multiple of 20. You make 8%. It's so cheap today, really. But I don't see it growing too fast. I think for a base case, we could see 10 EPS growth with a 22 multiple. You're looking at market-beating returns. That's not bad. And say somehow they reaccelerate to like their highest rates that they've ever been at, and they get a 25 multiple. This isn't going to happen. I don't think it could, especially if we see a valuation go up to 30 and we see 10% growth. But I think this is going to be close to like a 10% to 15% gainer over the next 5 years. It's not going anywhere. I don't think it has any room for like crazy outperformance, but I don't see much downside. So I'm going to put it in fairly valued today. It's close to undervalued. Is it the cheapest company in the fairly valued category? I don't think it's as cheap as Nvidia, Google, Mastercard. I don't think it's as cheap as any of those today. So I'm going to leave it there. And then next we have Lululemon. This one is crushed, as you can see from the price. 54% in a year. 5 years ago, you're still down 43%. It was once like a darling, but it's not a wide moat. It's a quality brand, I guess. But they don't deserve a high valuation. They don't. Their revenue is slowing, 8%. It was at 19% over the past 10 years. So I'm not going to dig into this one too much. EPS is still growing, but I think everyone's expecting this to slow down. Aloe and Viore are taking their market share. I think we could see EPS growth. Let's say a bear case, they're right above inflation. Let's say 4%, and they have a multiple of 12, which is what they deserve at that point. Roughly flat, minimal gains, like inflation level gains. So, and then I think base case, you could see this, we'll say 7%, a little bit below what they're growing at currently. We traded a 15 multiple. You see 10%. That seems a little high. We'll leave it though, 10%. And then let's say bull case, they reaccelerate. We'll give them 11%. And they trade at a 22 multiple. We'll give them this, and they get 23% returns. So there is a route for outperformance. I don't see it with the moat, with the direction of the moat, with the direction of the business, with competition coming in and eating their lunch. I'm going to put it fairly valued. Sorry about that. Cat decided it was dinner time with one company left. Last but not least, we have Palantir. This is one of the most impressive businesses in the world currently. The growth is insane. The revenue growth, the free cash flow growth. It's all ridiculous. The balance sheet's nice. But it trades at it's 356 trailing, 166 forward. They have to keep the growth. If not, investors will lose a lot of money. You know, its revenue is already at 4 billion, so it still has a lot of room to grow, obviously, but it's going to be hard to keep up the same growth rates. Let's say bear case, we slow down to a 20% growth rate. I don't see this happening. It's possible though. You have to look at the bear case. I'll give them a 30 multiple. You lose a lot of money. The share price would be 32 bucks in 5 years if this was the case. I don't think it's going to happen, but it's not impossible. We could see this happen. I think for a base case, we're looking at 40% growth rate, which is insane, but they're on track for it. 40% growth rate will give them a 30, almost a, we'll say a 38 multiple. You still lose money. Not as much, but your money's cut in half. And let's say they keep a 50% growth rate and a 50 EPS, and you are flat. So what investors are needing for positive returns, you're needing a 55 growth rate and a 65 PE for 8% returns. To beat the market, you need a 75 PE and 55 EPS growth rate for the next 5 years. It's not looking great. I'm going to put, it's a really, really high quality company and it's growing really fast, but I'm going to have to put it in the stay away tier. I mean, they have a chance to, beat the market. There's probably a 5% chance of them outperforming, but I just don't see it. There's a lot of downside risk. I'm going to have to put it in the stay away. It's a really nice company. I would love to see it trade down to like 50, 40 bucks per share. I don't think that's going to happen in the near future, but I would love it. I would probably add shares. But yeah, that's it for today. Let me know if you have any questions or what you agree or disagree with in the comments. And yeah, that's it. I hope you all have a great rest of your day.